Hello, good afternoon, everyone. I am Devashish Goyal, a chartered accountant by profession and host for today's webinar. I would like to welcome you all in ESOP Direct's webinar on ESOP surrender versus ESOP buyback as per Section 68 of Companies Act. Well, to give you a quick background about ESOP Direct, it is more than a 2-decade-old company which offers end-to-end advisory on equity-based compensation plans to wide sectors of companies. Well, we frequently conduct technical sessions on such open platform. And so in terms of this session, so any queries relating to today's topic, I would request all the attendees to write in the chat box and it will be addressed by our speaker at the end of the session. Well, now let me introduce my colleague Jeegar Shah, speaker for today, who is a professional company secretary with over 7 years of experience in capital markets. He has previously worked with listing compliance teams of BSE and MCX SX, where he gained expertise in ESOPs, preferential shares, and bonus share issue. Jeegar has been a part of ESOP Direct for almost more than 3 years and is based out of Mumbai. In his role, he provides consulting services to a diverse portfolio of clients, including listed and unlisted companies, startups, and PE-backed firms. Jeegar has successfully completed more than 50 assignments and demonstrating his comprehensive knowledge and skills in this field. I would like to welcome Jeegar and I would request you to please take forward this session.
Thank you, Devashish, for the wonderful introduction. Hi, everyone. I welcome you to this webinar on ESOP surrender versus buyback. So let's start the webinar with the introduction, a brief introduction of how the flow would be of this presentation and what would we cover in this. So the first portion here is of the applicability. So for whom this particular webinar is relevant. So I would say that this webinar is relevant for unlisted companies, more of private as well as unlisted public companies, and to an extent to listed companies as well. So we have seen that this particular option of surrender and buyback have been used by private companies and public unlisted companies for the purpose of option swap as well as cash settlement, and also to purchase back the shares that they have allotted to the employees through the stock options. Why the option of ESOP share buyback is not applicable in case of listed company is because that whenever an employee exercises the stock options, they buy the shares and they can sell it in open market to get an exit. However, with respect to open option swap for money or any other regrant of options, the option surrender part is more relevant. We have seen that in the new regulations of SEBI ESOP, there is SEBI SBAB regulation, a reference has been made to ESOP buyback. So that reference is more or less particular to settlement of options in cash by following the procedure which is laid down by SEBI buyback regulations to the extent applicable. It is a new uncharted area. So most of the things are kept open for the companies to decide. That is the terms of the buyback, the quantum of the buyback, but to certain extent they have to follow the SEBI buyback regulations while conducting the process. We have also seen that these terms, that is ESOP surrender and buyback, more particularly in unlisted companies, have been used synonymously. We see that many companies in their editorials or disclosures that they give to media companies say that they have bought back their ESOPs or they are coming up with a ESOP buyback offer. And usually such offers are cash settled. So it does not involve basically buyback of shares at any point of time, but it is more towards settlement of options in cash. So this both these options, basically option surrender or ESOP surrender, we should consider rewording ourselves to a particular word, that is option surrender, and not calling it as ESOP surrender. When we refer to as ESOP buyback, it is more towards shares. So these are different modes of settling or providing exit to the employees when they have shares or options under the plan, and at times making these options more lucrative. So we will see in the next few slides the implications and impact of both these alternatives. They have different meaning. They have different purpose, tax treatment, as well as legal implications. So in this particular presentation, we will highlight what is ESOP buyback, when it can be used, what are the pros and cons of this particular alternative, and same for ESOP, and same for option surrender. And in last, we will go through a comparative summary on of both these options at different level of parameters, that to consider which of the options has more complexity, is more easy to implement or contemplate in future from any company's perspective. Now, what is ESOP buyback? So basically, ESOP buyback is a mechanism wherein which the company can purchase its own securities and reduce the capital. So basically, effectively, buyback of shares by the company will effectively result in reduction of its share capital. So they are buying back, they're paying cash, and it will reduce the share capital of the company. Now, Section 68 is the only provision in the Companies Act which lays down the procedure by which the company can purchase its own securities, that is, shares of the company. Number one is authorized by the articles. This process of buyback should be authorized by the articles. Also, the buyback should be approved by board as well as shareholders. There are certain number of forms which the company has to file with MCA in order to get the process started, and even after the completion of the buyback. The pertinent thing to note here is that whenever a company is considering buyback, there are two limitations or two limits that are given under the regulations under the Companies Act, is that up to 10% of paid up capital and free reserve, the buyback can be done by the board itself. So no shareholders approval is required. And when the buyback limit exceeds 10%, but up to 25%, a shareholder approval is required to consider such a buyback. From practical standpoint, we can say that as the ESOP pool of the company is normally within the range of 10%, the buyback can normally sail through board's approval only. Coming to an important term of security. Basically, the term security has been defined in Companies Act by giving reference to Securities Contract Regulation Act, and this act specifically defines security, which does not include employee stock options. So we should be sure that when this term is used, ESOP buyback, it should more or less refer to buyback of shares and not buyback of options. So Section 68 basically allows us to buy back the shares from different class of shareholder. The first class is existing shareholders of the company in their proportionate basis. Second is from the open market. And third category is a specific class, which is from the employees of the company pursuant to a scheme of stock option or sweat equity. So they have created three classes under this section. So one of the section refers to as the employees of the company who have got shares from the company pursuant to a scheme of stock option or sweat equity. So by this, we can infer that buyback for only ESOP shareholders, only this particular class of shareholders who have got shares pursuant to exercise of stock options, a specific offer can be made to them as well by the company, and therefore it makes a liquidity avenue for unlisted companies. So practically buyback, as we discussed in earlier slide as well, it is not applied in listed companies as there is a ready market available for liquidity. The employee can exercise the stock options, purchase the shares and sell it into open market to get liquidity from the company. Now coming to the second point of this slide, an employee's participation in the buyback. So once the employee exercises the stock options, he becomes the shareholder of the company and is always treated pari passu with other shareholders. So normally an offer of buyback, when it is made to this ESOP class shareholder, by default such offer is voluntary. So it is upon the employee whether he wants to accept the offer and sell his shares to the company, or he may keep it with himself, unless the scheme is structured in a manner that whenever such offer for buyback is made, the employee is bound to accept such offer. So I would like to draw an attention towards acceptance of terms of ESOPs by the employee whenever the grant is made. So whenever we are making grant to an employee, we make sure that the employee accepts the grant. So when he accepts the grant, in turn, he also accepts all the terms and conditions of the plan as well. So if the plan is structured in a way that if in future there is a buyback offer by the company, the employee has to accept the offer and he will have to sell the shares. With respect to the pricing of buyback, there is no particular guidelines, though generally it is done at FMV or certain premium, because the ultimate agenda of having an LT plan is to pass on appreciated value to the ESOP shareholders. Now coming to the most opposite part of ESOP buyback. So in contrast with, basically, when we see in editorials and news disclosure that a certain XYZ company, investors or founders of certain XYZ companies have bought or purchased shares from the ESOP shareholders, and they normally refer it as ESOP buyback by investors or ESOP buyback by promoters. Basically, this is a simple sell and purchase transaction between the two parties and not a buyback under Section 68. As we referred to in the first particular para of this presentation of this slide, that whenever a buyback is contemplated by the company after the successful completion, it results in reduction of the capital. So this is not a reduction of the capital, it's basically a sell and purchase transaction. Second, whenever these options, these so-called options, are settled by way of cash payout, that is a value for value exchange. The option holder or the ESOP holder is surrendering his rights, his future rights to buy shares of the company, and therefore he's being paid out in cash in lieu of those surrender. And thus, this is also not a buyback under Section 68. We also see that certain disclosures or medias in media companies, it is referred to as an ESOP buyback offer given by the company, which the employees can sell their vested stocks to them. Yeah. So now analyzing this option, so when it can be used, basically. So the first use of this particular option is when uh, a company wants to give exit to an ESOP class shareholder if there is no other liquidity event possible. Say, for example, a closely held company had implemented an stock option plan which allowed the option holders to convert their options into shares once they are vested. So now there are too many shareholders, ESOP shareholders in the company, and there is no sight of any liquidity event in future. So the company wants to pass on the value of these shares to the employees, and therefore they can make an offer specifically to this class and purchase back these shares, and they can give them an exit. Second one is mandatory buyback clause in the plan document. So as I referred to in the previous slide, that there are certain companies which structure the scheme in a way that they insert a mandatory buyback clause in the future. So basically, after a certain period of time, or a discretionary clause in the plan document by which, as and when an offer is made by the board to the existing shareholders of the company, the employee is bound to accept such an offer and has to sell back his shares to the company. The third one is a very typical case, that is cleaning up of cap table before investor entry. So as many companies do allow the employees to exercise and take the shares of the company, it happens that over a period of time there are too many shareholders in the company, and most of them might have left the company as well. But being a shareholder, they always remain on the cap table. And at times you have seen that whenever a new investor is coming into the company, he would prefer to have more control on the cap table of the company rather than having too many shareholders on the cap table. In such a typical scenario, an offer for buyback can be made by the company, so that to an extent possible, if offers are accepted by the employees, then to that extent the capital can be reduced and number of shareholders in the company can be reduced. Now coming to the pros and cons of this approach. So the first pro, as we discussed in when to use option, exit is available to all the ESOP shareholders when no other alternative is available. or feasible by the company, when no other alternative is feasible. Manages or reduces equity dilution. So basically, when there are ESOP shareholders in the company, there are shareholders in the company, it dilutes the shareholding of the investors and the promoters or founders of the company. When we keep such an offer, when we contemplate such an offer for all the employees and they accept the offer, we reduce the capital to that extent. So the ultimate result here is that the percentage shareholding of other investors and founders effectively increase through this particular action. Exemption of capital gain tax for employees. So I would also like to draw your attention toward the last point of the cons, that is buyback distribution tax for the companies. So both these points are basically correlated. So when a company contemplates a buyback to its shareholders, they have to pay buyback distribution tax to the government. So to avoid double taxation, an exemption is provided also to the employees on the capital gain tax, which is applicable normally whenever they sell the shares to or transfer the shares to any other investor. Now coming to the cons of this approach, there is a cash payout. There's a high cash payout by the company whenever this particular option is considered. There is a lengthy regulatory process involved in this particular option. So as we discussed, that the company has to make sure that the process is authorized by the articles. Otherwise, there will be an amendment to the articles. They have to take the board approval. They have to file forms with MCA pre-buyback as well as post-buyback. They have to also ensure that they have enough reserve to consider this buyback. They have to also maintain a post-buyback debt to equity ratio. So considering all this regulatory process, a company may not want to consider this particular approach until and unless there is no other choice. So subject to the third one is the subject to maintenance of debt equity ratio. So this is basically in case of NBFCs, the non-banking financial companies, it is virtually impossible or difficult to maintain a debt to equity ratio because they are high debt companies. They have to take more debt. So they may not be able to consider this particular alternative because they may not be able to maintain post buyback ratio of 2:1, which has been specified in section 68. Now, another regulatory restriction here is that there is a 6 month restriction. So once a buyback has been considered by the company and successfully completed, the company cannot raise funds for another 6 months by issuing shares. So there can be a difficulty in fund infusion. So if the company is considering a fund infusion by way of investor coming into the cap table, there may be a difficulty if the buyback has been considered already by the company. So this 6 months restriction is particularly not applicable in case of already considered obligations. Like if the company already has issued options, they can still issue shares to those share employees who want to exercise in future. So if there are already obligations created by the company before considering this buyback, this 6 months restriction won't be applicable. The most important one here and a typical one is that offer cannot be made to a specific class ESOP shareholder. So what does this mean? Say in a company, there are few employees who have separated from the company, and the company wants to is considering to buy back the shares from them and take them out of the cap table or get rid them of the cap table. So this pick and choose offer cannot be done in case of this buyback, because the Companies Act provides that whenever an offer is made, the offer has to be made to the whole class and not a particular person falling into that class. And even the offer has to be equitable for everybody. So if the company is exploring for an option wherein it can pick and choose the number of people to whom it wants to offer for the purpose of buyback, it is not possible. It is regulatory restricted. Multiple buybacks in a year are not allowed. So this is not something that we can keep on offering buybacks every few months. There is a restriction around it that after every buyback, there should be minimum 1 year gap. So between two buybacks, there should be 1 year gap before which another offer cannot be laid out. Now coming to the next topic of this particular session, is ESOP or option surrender. So we should refrain from using the word ESOP. We should use option surrender because ultimately the employee will be surrendering his stock options which were issued or granted to him. So here I would like to draw your attention to the definition of employee stock option, which has been given in Companies Act. It is defined as an option which is given to directors or employees of the company to purchase. It's a right given to them to purchase or subscribe to the shares of the company at a future date at a predetermined price. Also, in the definition given by SEBI SBB regulations for listed companies, it defines employee stock option as a right and not an obligation on the employee to purchase the shares of the company at a future date. So from this, we know that this particular uh, employee stock option which is granted to an employee is not an obligation on him. That once an option is granted to him, he's bound to exercise it and he has to purchase the shares. It is always a right given to him that he can exercise it at any point of time, and therefore he can also choose not to exercise it. So this is a right given to him, but not an obligation to purchase or subscribe to the shares of the company. He can also choose that he may abandon or surrender his right in case if he is not interested in the plan or the plan is not lucrative. But he can do this at any time before the exercise, because once the options are exercised, they are converted into shares and the surrender right has already gone. So this one is interesting that the surrender may be voluntary. So the employee may suo moto choose to surrender the options, or it can be mutually agreed between the company and the employee depending upon circumstances. So basically, the later part of it, which is mutually agreed between the company and the employee, we will discuss this particular circumstances in the next slide. The voluntary surrender by the employee can be based upon if the plan is no longer lucrative to him, it is not creating any benefit, or the options have gone underwater. In such cases, he may choose to suo moto surrender the options. The surrender may be with or without consideration. So with or without consideration meaning he may choose to relinquish all his rights without any consideration being paid to him. So the consideration can also be in form of cash or in form of new options. So we will see that how it can be done in way of options or in case of shares, depending upon the type of the agreement between the mutual agreement between the company and the employee. Important thing to note here is that once the options are surrendered, they are left unexercised. So he is not exercising his right, and therefore they come back to the pool and they are available for regrant. So I would refer or I would bring back your attention to your stock option plans, respective stock option plans, in which you may see a clause that in case if the options are not exercised or are unexercised or lapsed or cancelled for any reason, in that case the options would come back to the pool and will be available for regrant. So this particular position here for surrender, it comes under the alternative that it is not exercised, they are left unexercised, and so they can be bought back to the pool. So as the company gets back the unexercised options for regrant, ESOP surrender is often treated as a liquidity event by way of cash payout to compensate for such loss to the employees. So as he is surrendering his valuable right, he's surrendering the right to purchase the shares of the company in future. It's a valuable right. Normally, companies also do treat this particular ESOP surrender as cash settlement, as a liquidity event, so that they give a way to the employees to get the benefit out of the plan. So there are certain cases in which the plan are linked to liquidity events and a few years have passed by, and in such case if there is no liquidity event, the company may opt for cash settlement in lieu of surrender of these options. Sometimes companies propose surrender of options against fresh grant of options with different price or different conditions. So this is a very typical case, a fresh case, We all know that 2 years back, when all over the world was struck by COVID, there was a huge fluctuation in the prices of shares which are listed, and due to certain unforeseen conditions, the company, certain employees or all the employees were not able to achieve their performance conditions. So to consider, basically to reward them, or to consider basically an alternative of how to make these options lucrative, the company may consider that they can surrender these options to them, and fresh options may be granted at a lower price in case the options have gone underwater, or the options can be granted with a relaxed performance condition. So if they see that the options were linked to certain corporate conditions which may not be achieved due to unforeseen conditions, they can offer them to surrender back the old options and grant them fresh options with relaxed conditions as well. So this particular thing can be done through option surrender as well. So now coming to analysis of this particular option. So when this option can be used by the company, or what is the suitable circumstance in which the company should use this alternative. So basically the scheme is not employee friendly, or it is there are underwater options in the company. So if over a prolonged time, after implementation of the plan, the company sees that the employee is not able to get liquidity, or the employee is not able to exercise due to the price being at par with the grant price, or has fallen below the market price of, or the grant price of the company, and the situation has been there for a very long time. So in order to make the plan lucrative for them, they can consider that the options can be surrendered by the company, surrendered by the employees, and they can issue new options to them. There is a mutual arrangement between separated employee and company for exit. So basically, we see that in many stock option plans, the company allows the option holder to carry the options with them. So once they are separated, so they don't want them to settle so early, so they allow them to carry the options, and at certain point of time, if they feel that the separated employee is willing to settle, or the company wants to settle such options, then such an arrangement can be taken into account, wherein the employee can surrender his option in lieu for of the cash payment. Mutual arrangement between companies, employees, and the company. So the first case is to swap option in case of liquidity event. So this is a very typical case. We are currently working with a company for this first alternative. So I would like to give a small example here. Say company A has acquired company B to be part of its group. It's not a merger, it's just an plain acquisition. So now company B will be part of company A. Company B has a stock option plan in which they have allotted granted options to the employees. Certain number of options are vested, certain are unvested. Now company A, as they have acquired the company B, they already have a global plan at the holding company level, and they want to cover all the employees in the subsidiaries in that particular plan, so that overall value of the group should be passed on to the employees and not at the subsidiary level. We know that here I would like to take a pause and refer to the definition of employee under Companies Act. So any employee means an employee of the company as well as its subsidiary or the holding company. So here, if the holding company is company A, they can also cover the employees of the company B under its plan. So what they have decided is that the employees of the option company B will surrender all their options, that is vested as well as unvested, and they will be granted options of company B under company A under their new plan with similar terms and conditions as there were in company B. Now, one thing to note here important is that there is a change of entity over here. So when one in company B, the employees are surrendering their rights, and in company A, when they are being granted the new options, from regulatory perspective, it will be considered as a fresh grant. So a fresh grant requires to comply with minimum 1 year of vesting period. So here it is not possible to adjust the vesting period that has already been completed by the employee in company B. But however, through mutual arrangement between both these companies, they have decided that after 1 year, they will adjust the vesting schedule in a way that aligns with the vesting schedule of company B as well. So this is how they have treated it in this particular incident. So they have swapped the options from company B to company A, and they have been it has been considered it will be considered as a fresh grant. Now coming to option B, which is cash settlement instead of equity at the time of liquidity event. So in case of liquidity event, the normal process is that the employee will have to exercise the options, convert them into shares, then sell it to the investor, and the investor will pay out to the company, and the company will reduce the taxes, all the liabilities, and pay the net settlement amount to the employee. So in order to save the whole hustle of exercising the options, allotting the shares, transfer to the investor, then company paying the employees out, at times, and even if the investor would want to settle them in cash in order to avoid buying more equity, so what they would do is they would ask the option holder to surrender their options and directly pay them out in cash net of taxes. So the value of the options will be equivalent to the price of the share at which the transaction is happening. However, the ultimate settlement would be in cash. Now coming to the pros and cons of this approach. Compared to buyback, this is very much less regulated. Hence, it is simple. More of emphasis towards the contractual agree arrangement between the employee and the company. It is suitable for providing exit to the separated employee. I would like to bring attention here to the third point of con as well, that this is a pro as well as this is a con, because at times we have seen that the plan does not have an enabling provision that they will be able to treat separated employees differently from the existing or the continuing employees. So a plan should have an enabling provisions that in case if the board wants, they can settle the separated employees differently. However, a company can consider such an after going through the plan document and considering several options, the company can consider settling the separated employees, but it can create a governance issue because while approving the plan, the shareholder did not expressly approve that the separated employees will be settled ahead of the continuing employees. So the liquidity for separated employees will be much faster or much earlier as compared to the continuing employees, and even it creates a bias towards the continuing employees who have been creating value in the company. So we should consider this particular option very cautiously, and we should make sure or we should plan it accordingly that there is a permission in the there is a enabling provision in the plan document that allows us to treat the separated employees differently. Now value for value exchange in case of cash payout. So as I had referred to this earlier, that as the employee is surrendering his important right to buy shares of the company in future, he is being paid cash. And same goes for the value for value exchange in case of options. I just gave an example around that there may be cases when the employee has to surrender his old options in order to get new options in the same company, in if there is a case of uh, underwater plan or in case of in new company for certain corporate adjustments. Multiple settlements in a year is possible. So this is a very positive point, because it is not regulated by Companies Act. The plan can enable us to provide multiple settlements in a year. So as and when the board seems it apt, they can contemplate such settlement and provide exit to respective employees, separated or otherwise. Settlement in separation cases is possible. So as I had referred earlier as well, that if there is an enabling provision in the plan, we can settle the separated employees, irrespective of whether we are providing exit to continuing employees or not. So there are certain circumstances in which the company may consider it's better to get rid of the separated employees who are not generating value in the company. However, they are getting the benefit of the higher value because they are linked to equity shares of the company. Now, coming to the cons of this approach, it's a high cash outflow approach, because whenever we are settling these options, we are paying them out in cash. So there is a hit on the books of the company. Second, high accounting cost, mark to market basis in case of guaranteed cash settlement. So I would refer here that there are in certain companies, there are clauses that guarantee cash settlement. So basically, after 7 years or 8 years from the date of inception of the plan, whatever period they've specified, that there is no liquidity event, the board shall consider cash settlement. So basically, they are giving the right that once this period is over, they will be compulsorily settled in cash. They will not be carried forward. These options will not be carried forward henceforth. So in this case, as the period goes by, the company will have to take accounting costs. They have to create enough reserves in their books so that ultimately, when the time comes, they have enough cash to pay all the employees out. This point I have already covered, that this separated employees clause should be there. This provision should be there in the plan document to make a smooth offer to the separated employees. May curtail future appreciation in case of early or mandatory settlement. So basically, in certain cases, the board normally considers that if there are enough cash reserves, instead of waiting for future liquidity event, they decide that we will settle everything in cash. And the plan is designed in such a way that they do not give a choice to the employees that whether they can choose to accept the offer or may carry forward their options in future for future settlement. In such a case, when an offer is made, it may not give a choice to the employee that he wants to wait for long term appreciation. This choice will not be available for him, and he will have to opt for cash settlement mandatorily. And the other mandatory settlement is basically the time bound settlement. So from the inception of the plan, if there is a certain period return, then it has to be settled. Swapping treated as fresh grant. So as I told in my previous example of company A and company B, so when the entity changes, the new grants that are made with similar terms, in that the minimum vesting period has to be complied with. So if any employee who leaves the company may have to part with the options as unvested, if he leaves the company as soon as he joins, as soon as the options are granted in the new company. So this is basically the final slide of both these alternatives, basically ESOP buyback and option surrender. So we have considered different parameters based on which we are evaluating which one is has more positives, or basically which is easy to consider or contemplate by the company. Would like to draw attention here that we are seeing more greens on option surrender as compared to buyback. However, it is more situational based or context based. The company should evaluate all the options and then consider which alternative is suitable to the company. So now coming to the first point, regulatory complexity. In ESOP buyback, as we saw, it is regulated by Companies Act, so the complexity is very high. In case of option surrender, it's comparatively low because it is more of a contractual arrangement. Multiple transactions in a year not allowed. Minimum 1 year gap is required. In option surrender, it is allowed. Cash payout is same because ultimately we are settling. It is linked to the equity share value of the company. So whenever we settle, it will be at that price. So the cash payout from the company will be same. Settlement in employee separation not possible. In option surrender, to an extent possible, or I will say possible that it can be done. In ESOP buyback, as I told, that whenever an offer is made by the company, it has to be made to the complete class of ESOP shareholders, and it does not have an option to pick and choose. Accounting cost comparatively low, and here comparatively high, because the first option is based on equity settlement, so the cost is fixed whenever it is amortized. And here, as we are considering cash settlement, there will be a hit at the end which will impact our cash flow. Corporate tax saving, comparatively low. It depends upon the timing of the buyback. And in case of option surrender, it will be high. Corporate tax saving will be high because ultimately we will be paying out cash, which can be used as a deduction in our tax books. Saving in equity, yes, but with the reduction of ESOP pool. So we are ultimately saving the equity here because we are reducing the pool. So we are not effectively diluting our cap table. We are buying back and reducing our cap table capital as well. So there is no pre-post buyback change in terms of dilution. In option surrender, if they are re-granted once the options are surrendered, there will be a potential dilution that may happen in future, and therefore uh, there is no saving or limited saving in terms of equity in case of option surrender. So yeah, this is the last slide. Devashish, we are open to questions. We can take questions if there are any.
Thank you, Jigar, for your insights on the topic. Yes, we have got queries from the attendees, so I would place in front of you. The first question we have is, if few shareholders do not accept buyback offer, then can the company buy more shares from other shareholders who are willing to make offer shares for buyback?
Yeah, so normally the offer is always made on a proportionate basis. So if a few of the shareholders do not accept, then to that extent, on proportionate basis, the company can accept shares from other shareholders as well.
Okay. Next question we have is, can a buyback clause be mandatory in the plan document?
It can be made. So it is contextual. If the company thinks that there may be a situation where they will be allowing shares to be held by employees, and there can be possibility that there will be no other liquidity event, they can make it mandatory. So it's purely contextual. And yes, but by inserting it in plan document, we can make it mandatory, because ultimately while accepting the grant, the employee is also accepting the terms of the plan as well.
The next question we have is, in case employee surrender options, can company reverse its cost booked as per Ind AS? Black and Scholes model.
Okay, so in case of surrender, the cost cannot be reversed because they have not been exercised. So yeah, the cost reversal is not possible.
What would be the valuation methodology for option buyback from exiting employees?
So as I told that there is but no valuation guidelines given under the law. It can be based on whatever price the company wants. Normally it's on FMV. A new valuation exercise is done through an independent merchant banker or a valuer to make the process more transparent, and company can accordingly deal with this valuations. But there are no regulatory guidelines around it.
Okay. The next question is, in ESOP buyback, a person should be in employment of the company at the time of buyback.
Come back again.
In case of ESOP buyback, if a person, the person should be in employment of the company at the time of buyback event.
No, it's not necessary to be an employee of the company, because he's already the shareholder of the company, which is of more important. He fits into the class of the ESOP shareholder. So either or irrespective of his employment status, whenever an offer is made, offer will be made to the whole class. So he will be part of that offer.
Okay, the next question we have is, if company had buyback its ESOP, can it still allot ESOP to its employees within 6 months?
Yeah. So as I told that once the buyback has been done, the issue of the issue of shares or the issue of ESOPs is not restricted. The options will not be converted into shares immediately. There is a minimum 1 year vesting period after which the employee gets an option. So there is no restriction on granting of stock options.
Okay. The next question we have is, in case of buyback, if ESOPs and ESARs are notional pooled reserve for the plan, then in case of happening of exercise event, will the company have to mandatorily first issue shares to the grantees and then do the buyback?
Yeah. If there is a notional pool.
Yeah, there's a notional pool.
So yes, I mean, effectively, the buyback would not be done to. It will not be considered as a buyback per se because there are no shareholders. There are no ESOP class shareholders as of now. But if the company gives them an opportunity to exercise and purchase the shares or subscribe to the shares of the company, once they become the shareholder, yes, the offer can be made to them for the purpose of buyback. Otherwise, as those particular options are in the form of ESARs or options are in the form of options, they can consider option surrender and payout.
Okay. The next we have is in case of a cash settlement, would uh, in case of determining the settlement price, shall it be based on valuation report?
Yes, so normally, even under the broad guidelines or the contours of the plan, we specifically give reference to the FMV. If in the plan document that whenever the cash settlement or settlement in cash is considered, some pricing formula has been specified. If not, even in that cases, the company should consider giving it at FMV from an independent valuer. However, in general, yes, the FMV is considered.
The next question we have is if company keeps settling the options with cash, when the ESOP pool will reduce, investors will not agree for this right as they are already cashed out.
Yeah, so it depends upon the context. We have seen a few plans in which they feel that the investors do feel that if the options are being cashed out by the company, then they should not come back to the pool and effectively should reduce the option pool. The company can consider it through its plan document that if such a liquidity event is considered, we will not bring back such options that are settled in the option pool for regrants.
Okay. The next question we have is ESOPs vested but not exercised by the employees. What impact would it have on ESOP buyback?
Uh, it will, in terms of buyback, there are two approaches. So basically, if the plan is open-ended, then in that case, the employee will be given an opportunity to subscribe to the shares and then sell it in the buyback. And if not, then in that case, if offer is only made for the existing shares, then the vested options can be kept aside. So it depends on the offer. In certain offers, the company do allow that the ESOP holders can convert their vested option into shares and also offer them in the ESOP buyback to the extent of the quantity they want to buy back.
Okay. Can ESOP bought back without first converting it to share?
So that is particularly surrender of options. As I told that it's not a buyback, it is a settlement, it's a surrender of his rights. He will not be able to subscribe to the shares of the company in future, and therefore he will surrender these options in lieu of the cash payout. So we will not call it buyback because effectively through Companies Act, when we are buying back the shares, we are also reducing the capital. Here, in terms of options, we are not reducing our capital. It will be a buyback. Sorry, it will be a surrender and settlement.
Okay. The next question we have is can a company raise funds from other than equity, that is preference shares, after buyback within 6 months?
Yeah, so basically, it cannot it cannot issue similar type of shares. Yes, but through different securities, it can be done. Fundraise can be done. Yeah. So instead of shares, they can issue debentures or preferential shares in order to raise funds.
Okay. The next question we have is in unlisted company, if liquidity event is delayed, in case company decides to buy back ESOPs, what would be the tax liability for the company?
So for company, there will be no tax liability basically because there is a cash outflow for the employees, whatever the net cash payout is. So for example, say the company had allotted options with a grant price of 100 rupees. And when it considered the settlement, it was done at a price of 1000 rupees. So the net payout when the company is considering this surrender and cash settlement is 900 rupees. This 900 rupees will be subject to the slab rate taxes which is applicable to the employee. So the company will reduce this taxes, say 30, 35%, whatever slab rate the employee falls into, it will deposit with the government and pay out to the employee. But however, the company itself does not have any tax liability.
Okay. Then next question is, if the performance of the option holders is not likely to achieve, can the company revise their grants instead of going with option surrender process?
Yes, they can revise their performance parameters by taking approval from the board. It depends upon the structure of the scheme. At times, it may require that it may require amendment of the plan itself if the performance conditions are hard coded. Uh, so yes, but instead of going for surrender, there are other possibilities like getting board approval for relaxation of this performance terms and then issue a revised letter.
Okay. The next question we have is how to settle unvested ESOPs.
So unvested ESOPs, basically if they have crossed 1 year of mandatory vesting period, and if the plan permits with the board approval that they can be accelerated and converted into vested options, the company can get the unvested options approved to be vested through a board approval and can be considered for the purpose of settlement. I think Devashish, we have reached that 1 hour mark. If there are any few questions more, we can also take them, or
Yeah, so we can take the last question and maybe we can ask them to write on a mail. So the last question is, how can listed company propose surrender in case it's not mentioned in plan and there is no regulatory clarity based on compensation committee or board approval?
okay. So as I told in the start of this session that this is an uncharted category. 1.5 years back, this option was not available. Once the regulations were amended in 2021, this option was made available. Even in the consultation paper which was released by SEBI, they have specifically told that the terms of buyback have not been suggested by have not been suggested in the regulations. They have told that to the extent possible they should refer to SEBI buyback regulations. However, it is important that if they are considering the buyback, those terms should be part of the plan document which is approved by the shareholder. So if today the terms are not there in the plan or the enabling power is not there in the plan has to be amended, approved by the NRC board as well as the shareholders in order to consider such an option.
Okay. One more question. In case of buyback, is there any tax liability on part of the employees?
So on employees, there is no tax liability. As I told that the capital gains is exempted because the company has to pay the buyback distribution tax. So there is effectively no tax liability on the employee. However, in a few cases, depending upon the type of arrangement, the company may reduce the tax it has paid from the net payout to the employee.
Okay. So Jigar, we have a few more minutes, so I'll wrap it up. Couple of more questions.
Sure.
Yeah. Yeah. So if okay, one second. Okay, if is limit of 200 shareholders applicable for ESOPs also? Do company need to track that its shareholders are not more than 200, as in the including employees who
Yeah.
have not exercised options? Yeah.
No, not in case of not exercised options. Basically, the shareholder count is uh, computed based on the shareholders which are present on the cap table and not the virtual or the, you can say, the numbers which are not yet on the cap table. So if there are option holders, the company may not consider them as 200 shareholders until and unless they come on the cap table of the company by becoming a shareholder.
Okay, the next question is, in case of option surrender, under what head should the cost of cash settlements be shown so that it doesn't attract any tax liability on part of the company?
So it will be an employee cost, basically an ex gratia, bonus ex gratia, or the employee cost. In that head, it will be shown. And as I told that whenever a cost is being paid out by the company upon this surrender, it does not attract any tax. It is basically a deduction available for the company. It's an employee cost and it's a deduction available for the company in books.
Okay, I think we're done with the Q&A round now. So we can end this session. I would like to uh, thank all the attendees for coming up and attending this session. I hope you all like the session, and whatever insights has been shared by Jeegar, all your queries have been resolved.